Most traders crash in their first year because they chase consistency in the wrong place. They believe consistency means winning every trade. It doesn't. Real consistency is a system, not a streak. And that system begins with the 1-hour chart. Here's the brutal truth. Around 87% of retail traders fail because they trade too many time frames at the same time. They jump from the 5-minute chart to the 15-minute, then to the hourly. Their brain never settles. Conviction breaks down. They cut winners early and hold losers too long. The 1-hour chart fixes this. It's the Goldilocks time frame, fast enough for intraday opportunities, slow enough to filter out noise. It forces patience onto an impatient mind. But here's what separates professionals from amateurs. Professionals trade the 1-hour chart with rules, not feelings. An amateur sees a setup and enters on hope. A professional sees the same setup and asks, "Does this fit my system?" Then they either take it or walk away, without guilt. Consistency isn't about being right more often. It's about being disciplined more often. In the next few minutes, I'm going to show you 5 non-negotiable steps professionals use to turn the 1-hour chart into a reliability machine. These steps aren't revolutionary. They're boring. And boring is profitable. By the end, you'll have a framework that removes emotion from your decisions. You won't guess. You won't hope. You'll execute. The catch is this: you must commit to it even when the market rewards breaking the rules. Especially then. That's where 93% of traders fail. They follow the system for 3 good trades, then abandon it on the 4th because they feel a move coming. We'll address that psychological trap later. For now, understand this: the 1-hour chart is your stage. Every entry, every exit, every loss teaches you something about yourself as a trader. On lower time frames, a bot can trigger a flash move. A news release can cause a tick spike that means nothing for the 1-hour trend. On the 5-minute chart, you're trading ghosts. On the 1-hour chart, you're trading structure. Price must prove itself over 60 minutes. It can't fake it. That's why professionals gravitate to the 1-hour. It's the minimum time frame where structure is real. Here's what most traders miss. The 1-hour chart doesn't just filter noise. It forces patience on a psychology that craves action. Trading at its core is a boredom problem disguised as an analysis problem. Amateurs think they lack analysis skills. Most of the time, they lack patience. They want to trade now, so they find a reason to enter. The 1-hour chart removes that temptation by making false signals obvious. On the 1-hour, you're waiting for 1 candle every hour, maybe fewer. In an 8-hour day, that's 8 potential opportunities. Most traders will only see 2 or 3 real setups. The rest of the time, you're watching, learning, and doing nothing. Doing nothing is the hardest trade for amateurs. It feels like failure. It feels like leaving money on the table. Professionals understand that the best trade is often the one you don't take. Jesse Livermore made his fortune waiting. He called it waiting as a position. The 1-hour chart enforces this lesson. It teaches your brain that inaction isn't a loss, it's discipline. The rules I'm about to share only work if you commit to this foundation: 1 time frame, the 1-hour, and nothing else. No peeking at the 5-minute for confirmation, no checking the 4-hour for context. Just the 1-hour. This singular focus separates traders who make money from traders who talk about trading. The ones who talk are multi-time frame junkies. The ones who make money aren't. Here's why. One trader was winning frequently, but every winner was $80 and every loser was $150. He was getting whipsawed by noise. His setup recognition was fine. His stops were tight. But the market structure during his trading hours was against him. The math was broken from the start. Then he shifted to trading only the London Open, 8 a.m. EST, same signals, same system, same discipline. Suddenly, winners were $200 and losers were cut at $60. His win rate didn't improve. It stayed around 52%. But his edge transformed. Why? Because during London Open, the USD is flooded with institutional flow. Banks are active, hedge funds are positioning, retail traders are engaged, spreads are tight, volume is real. A 1-hour candle during London Open tells you something meaningful about money movement. A 1-hour candle at 6 a.m. EST tells you almost nothing. That's just noise waiting for the real market to open. This is the invisible killer that separates amateurs from professionals. Most amateurs think their system is broken, when really their timing is broken. They're trading good setups in bad market conditions. It's like a skilled archer trying to hit a target during an earthquake. Skill doesn't matter if the environment is hostile. The protocol is simple and non-negotiable. Track your instrument's best liquidity window. For stock indices like ES or NQ, that's the New York Open, typically 9:30 a.m. to 11:30 a.m. EST, volume explodes. Institutions are active. Retail participation is high. For Forex pairs like EURUSD, it's the London and New York overlap, roughly 8 a.m. to 12 p.m. EST, liquidity deepens. False signals flatten out. For crypto, liquidity is technically 24/7, but your psychology isn't. You must choose your sharpest mental window. Morning or evening, it doesn't matter. Consistency does. Write this down somewhere visible. I trade the 1 hour between and only. No exceptions. Post it above your monitor. Make it a mantra. This single rule removes over 60% of weak signals and eliminates constant overtrading. Professionals don't trade all day. They trade their window. Outside that window, they're unavailable to the market. They rest. They recover. They don't second guess. Amateurs are always on, alerts buzzing, charts open everywhere. That vigilance doesn't increase edge. It destroys it. Professionals define when and where they trade, then lock it in. An amateur is still figuring this out hundreds of trades later. Once your window is defined, the next step is recognizing what quality price action looks like inside it. Markets behave differently during high-quality windows. Volume is predictable. Volatility has rhythm. Support and resistance matter. That's why recognizing pivotal points is critical. Most traders see any bounce and call it a setup. Professionals don't. They filter for structured hesitation. A pivotal point is a level where price pauses, consolidates, and shows rejection. Not a quick bounce, not momentum. Structure. An amateur sees price drop, bounce, go up, and enters. A professional asks 3 questions. Did price pause? Did it show rejection? Did structure form? That difference separates traders who lose money from traders who build equity. A pivotal point isn't an indicator. It's a pattern. It's where institutional money defends a level, where weakness is absorbed and strength begins to form. In 2024 volatility, I mentored a trader trading ES on the 1 hour. His window was solid, but he took every bounce. One move looked good, but had no structure, no rejection, no volume. He lost $200. Later that day, price dropped again, but this time it paused. 3 full 1-hour candles. Volume spiked. Lower wicks showed defense. Structure formed. He entered after confirmation and made $420. Same market. Same system. Different quality. That's the lesson. It's not about more trades. It's about better trades. Before entering any 1-hour trade, ask this. Did price pause for 2 to 3 candles? Did rejection appear? If not, it's not a setup. It's noise. Price is pushed back up, creating a wick, or rejection can appear through candle body structure, where the close is significantly higher than the low of the candle, or it can appear as a volume spike at that level. Any one of these patterns tells you that something rejected the lower price. Something stepped in and said, no, we're not going lower. That something is institutional money. That is the signal. An amateur sees a bounce and enters. A professional sees a bounce with rejection and enters. The third question is this. Is there directional confirmation? After the pivotal point forms, do the next 1 or 2 candles move in your intended direction? This is critical because it tells you the pause has resolved. The wrestling match between buyers and sellers is over, and the winner is now walking away with control of the market. If you see a perfect pivotal point, but the next candle closes lower, that's not confirmation. That's the market saying false alarm. You wait for the next setup. If you see a perfect pivotal point, and the next candle closes higher with strong volume, that is confirmation. The buyers have won. Now you can enter WUI. Conviction. Here's where it becomes subtle but important. If you can answer yes to all 3 questions, the setup is tradable. Anything less than that, you wait. This is where professionals and amateurs truly diverge. An amateur sees a beautiful pivotal point without directional confirmation and enters anyway because the setup looks good. A professional sees the same structure and thinks, the pattern is there, but the market hasn't confirmed direction yet. I'll wait. And then he actually waits. He waits for the next candle, or the one after that, until confirmation appears. Or he walks away entirely because confirmation never comes and the pivotal point turns out to be a trap. This is the part most traders never understand. Waiting is the trade. Doing nothing when the setup isn't clean is often the highest conviction decision a trader can make. It feels counterintuitive because trading culture glorifies action. More trades, more opportunities, more wins. Professionals understand the opposite. The best trade is often the one you don't take. If you skip 10 mediocre setups and take 2 clean ones, you are already ahead of the trader who took all 12 and got whipsawed on the 10 bad ones. Your raw win rate might look lower, but your edge is stronger. Your average winner grows, your average loser shrinks. Over time, the math compounds in your favor. Think about this. If you see 3 pivotal points during your trading window and only one has full confirmation, you're filtering out roughly 67% of potential trades. That sounds bad on the surface. But those 2 filtered out trades are often the exact trades that would have cost you money. That one clean trade makes up for both of them and still leaves you profitable. That's how professional traders think. They aren't trying to maximize the number of trades, they're trying to maximize the quality of trades. Here, the psychological benefit most people miss. When you commit to the 3-question protocol, you develop conviction. You take fewer trades, but you take them with absolute certainty. You're not guessing, you're not hoping. You've asked 3 questions, received 3 yes answers, and now you are executing. That conviction changes how you manage the trade. You don't panic at the first wick against you. You don't take profit early out of fear. You hold the trade because you know the setup is solid. And that holding, that conviction, is what turns small winners into big winners. Amateurs don't have this conviction because they enter on hope. Professionals have it because they enter on structure. The difference in outcomes is dramatic. Over 100 trades, a professional's conviction-based holding turns mediocre results into profitability. An amateur's hope-based cutting turns solid setups into break-even or losing trades. From this moment forward, when you see a bounce on the 1-hour chart, don't ask, should I trade this? Ask, does this pass the 3-question test? If the answer is no, you already know what to do. Nothing. Wait, be patient. The pivotal point will come. And when it does, with all 3 confirmations, you'll enter with the conviction of a professional. Here's what kills traders faster than bad setups. Good setups with bad position sizing. This is the invisible assassin in trading. A trader can have a perfect entry, perfect stop-loss placement, perfect exit discipline, and still blow up an account because the position size was wrong. On the other hand, a trader with a mediocre setup but disciplined sizing will survive long enough to learn, adapt, and eventually win. The survivor wins the game. This isn't theory, it's mathematical law. And it's the real reason why 87% of retail traders fail. Not because their analysis is bad, but because their sizing is reckless. Let me be clear about the hierarchy. Professionals think about position size before they think about entry. They calculate it before the trade is placed. Amateurs think about position size after they're in profit and already dreaming about yachts and early retirement. By then, it's too late. The damage is already baked into the trade. An amateur enters a trade, it moves in his favor, and he thinks, what if I had sized bigger? So on the next trade, he does. And that's when the market reverses and wipes him out. The position was already too large to survive a normal drawdown. Now, here's the math. And I want you to really sit with this number because it will permanently change how you think about risk. If you risk 2% per trade on your account and you experience a 10-trade losing streak, which is normal, not catastrophic, you don't lose 20%. You lose about 18% due to compound drawdown. Why? Because each loss is calculated on the remaining balance, not the original balance. After the first 2% loss, your account is at 98%. The next 2% loss is 2% of 98%, not 2% of 100%. By trade 10, your account is significantly eroded. Psychologically, you're wounded, your confidence is shaken. You start making desperate decisions with what remains. Now compare that to risking 1% per trade. Same 10-trade losing streak. You're down about 9.5%. You're hurt, but you're still standing. Your account still has roughly 90.5% of its capital intact. Psychologically, you're in a completely different state. You can take the next trade with clarity instead of desperation. You're thinking about the market, not obsessing over losses. And that clarity compounds over the next 20 trades. This is why professionals size small, not because they lack conviction, but because they have deep respect for the market's ability to surprise them. Jesse Livermore understood this better than anyone. He made and lost fortunes multiple times, and every time he rebuilt, he did it with small position sizes. He had a rule: trade as if you're wrong. What he meant was this: size your position as if the trade might fail, because it might. The market is the only truly honest thing in trading. It doesn't care about your analysis, it doesn't care about your conviction, it cares about order flow, and flow can reverse instantly. So here's the protocol professionals follow, and it's simple enough that there's no excuse for ignoring it. For your 1-hour trades within your defined window, you will risk no more than 0.5% to 1% of your total account per trade, not per day, not per week. Per trade. This is the ceiling. Above it, no matter how good the setup looks. The second rule is critical. You calculate your position size from your stop loss, not from your profit target. Most amateurs do this backward. They think, I want to make $200 on this trade, so I need X contracts. Then they place the stop and hope it doesn't get hit. Professionals think differently. My stop loss is 20 pips away. My account is $10,000. I'm risking 1%, so that's $100. At 20 pips for $100 risk, that determines the position size. The size comes from the stop loss, not the target. This removes guesswork completely. The formula is simple. Account risk in dollars divided by stop loss distance equals position size. Let's make it concrete. You have a $10,000 account. You risk 1% per trade, which means your maximum loss is $100. You're trading an ES setup on the 1-hour chart. Your stop loss is 20 points below entry. $100 divided by 20 points equals 5 micro contracts. On the ES, each micro contract is $1 per point. 5 micros means you're risking exactly $100 if the stop is hit. That's precisely 1% of your account. No more, no less. Here's what this protocol does. It completely removes greed from the equation. You cannot oversize because the math doesn't allow it. An amateur sees a sure thing and wants to size up. But if he follows the formula, he physically can't. The math says 20 points, $10,000 account, 1% risk equals 5 micros. That's it. There's no room for emotional decisions. No room for I feel this one. The math is the boss, and the math doesn't negotiate. This is where psychology becomes dangerous for amateurs. Most skip this step entirely. They eyeball their size. I'll take 10 contracts, they think, without doing the math. When the trade goes in their favor, they regret not sizing bigger. So on the next trade, they take 15 contracts. And that's when the market reverses. They get stopped out for a $750 loss instead of a $500 loss. One bad decision ripples, one oversized position,